Before we move on to a more complex situation, we need to understand a couple of key concepts. The first is, a debt for one person is an asset for another person. So, for example, when you receive a telephone bill, that bill is a debt for you, but an asset for the telephone operator. The second is time-related categories for assets and debts. Any item that can be sold, used, or dealt with quickly is called current or liquid, while any item that cannot be sold or used up so quickly is called non-current, fixed, or long-term. Let us check to see the two sides balance. If they do, then you have just succeeded in completing a rather complicated balance sheet by yourself. As you can see, the bigger and more complicated a business becomes, putting all the business transactions and activities into numbers becomes extremely difficult and complex. Welcome to the corporate world. There are three basic ideas: revenue, expenses, both operating and non-operating, and net income. This is a typical company's income statement. I think the various items are simple enough to understand. Please take a couple of minutes to become familiar. Notice the key ideas: gross profit, operating income, and net income, and how we arrive at these figures. The cash flow statement sounds the same as an income statement. So before we proceed, we should bear in mind a couple of important differences. The first is timing. That is, between the time the income or expense is recorded and the time the cash actually comes in or goes out. In accounting, it is called the cash method versus the accrual method. The second key difference is the inclusion in the cash flow statement of items that are not shown on the income statement. The cash flow statement has several categories of transactions. Looking in detail, return on assets, or ROA, which equals net income divided by total assets. This is a gauge of profit in relation to a company's size. So that means how efficiently the company is using its assets to generate profits. A corporate group exists when there is a parent company at the top of a pyramid and there is at least one other company that the parent company owns, either 100% or partially, lower down the pyramid. More on the percentages a bit later. As the purpose is to represent all assets, liabilities, income, and costs as if they were all one entity, all internal balances and earnings must be eliminated. That means only showing the profits and/or losses as if they were generated by a single aggregated company made up of the parent and subsidiaries, and so on, after they joined the corporate group. And finally, we move to the footnotes on key items. When you look at financial statements, you will notice at the end a number of pages of some small print entitled Footnotes to the Consolidated Financial Statements. As the name suggests, these are like explanations of the disclosed figures, which the figures alone would not make clear. We will look at the main ones only. They are asset valuation, depreciation, and foreign currency conversion. Now, let us recap on the ideas for the cash flow statement. Here, we have a typical statement. Please have a careful look and then consider the questions. Please note the negative cash flow figures, that means cash outflows, are put inside brackets. Please categorize the items here into either operating or investing or financing activities. I think the answer is fairly straightforward. You add the beginning retained earnings of 10 million to the net income of 5 million, which means 15 million yen. From this figure, you subtract the dividends paid of 4 million, and so you should then get 11 million